brand new portfolio setup for the micros and stock indexes E-minis. It's a 40 strategy setup, 20 ES and 20 NQ strategies. You see it here in the micros, you see it here in the E-minis, and basically what this is, it's very simple. It's a combination of the micro NQ20 portfolio with a couple of adjustments that I'll go over, and it's a combination of the stock index portfolio 27 on the ES strategies with a couple of adjustments. So I want to make this simple and break it down. The stock index portfolio 27 right here has been one of our strongest setups. It includes 19 E-mini S&P strategies. We're going over the stock index portfolio right here. 19 E-mini S&P strategies, 8 E-mini Nasdaq strategies. Now if we take a look at this portfolio, this is a portfolio that was developed at the end of 2020. We made one adjustment to AT20 NQ in the middle of 2021, and that is the only adjustment. It has held its worst case drawdown, and so we like the strength there. Let's isolate and look at just the 19 E-mini S&P strategies that we're talking about, basically adding the ES strategies to the micro 2020 NQ. This alone is a nice setup, just trading these 19 E-mini S&P strategies. And so if you take a look at just this, that alone could be a good portfolio with a low drawdown. And you can see the cyclical nature of this. It's near equity peaks. We are making 2 adjustments to this for the stock index portfolio 2020. So we're going to the stock index portfolio 2020, and on the E-mini S&P, it's the same as the stock index portfolio 27 with these changes. We're changing after hours ES 2.0. We're going to use after hours ES 3.0 instead, and we're adding tick fader. So just 2 simple changes. And then on the E-mini Nasdaq, we are including all 8 strategies, same 8 strategies that are in the stock index portfolio, except we're using AT 2022 instead of AT 2020. They're very similar. We've made some adjustments. So there is one update for AT 2022, and this includes all the micro NQ20 portfolio strategies. So there's 20 strategies in the micro NQ20. So if you just take the micro NQ20 strategies and add them, and we're making these 2 changes right here. And the micro NQ20 already includes AT 2020 NQ. So I'm highlighting the differences between these. So we're merging 2 portfolios, 20 on the Nasdaq, 20 on the S&P with some very small changes. We're using the Cobra 3 with a range filter, which is a better version, which hadn't traded much this year. And then we're using tick pullback 2020B with an increased stop loss from 15 points to 100 points. And we may have additional adjustments as we're researching each strategy and making adjustments. There could be rolling adjustments to this. So let's look at this. This is for start of February the 4th. If you have a micro portfolio subscription, the 50K portfolio subscription, or the 200K or All Strategy Access, you'll be getting these updates so you could trade one of these setups during this volatile time period. So if we look at it, it's right here, stock index portfolio 20 or stock index portfolio 40 for February the 4th, 2020, and we need to add the Nasdaq. We're going to go ahead and add all these back. It only includes the Nasdaq and S&P, but we're just by default we include all these right here, and you can see the results. Now don't panic on this because we are looking at data going back to let's go back 10 years. This goes back to 2008. The current market levels are nothing like 2008. The current structure of the market is nothing like 2008. And so if you look at the equity curve, if you look at the drawdown curve, we're going to go back 10 years, and then we're also going to go back to mid-2016 so you can see the results of this setup. And so to do that, I'm going to go into the daily P&L, and I'm going to go back here and delete data prior to 2012. I'm going to scroll all the way back here. This is how you can do it on your side if you want to do it as well. If you want to look back to long back tests are good, but we want relevance, and so we need data that's relevant to the current market, and the closer we get to the current market, the more relevant the data is. It's nice to have strategies that work back 30 years, but the markets are much different. So we're going to delete everything before 2012, and then let's take a look. So the worst case drawdown is 50,000. You risk 22,000 or you're risking 2,200 per micro. Now these drawdown numbers and stop losses are going to have to go up because volatility is larger. So one of the reasons why we're scaling back to micros in some of these, if you have a $200,000 account, when volatility is 10 times greater, it's more like a $25,000 or $50,000 account. So it's not as big as it used to be in the futures world. To have a portfolio that's a futures account that's $200,000 was respectable. With this kind of volatility, you have to be very careful because you want to preserve that capital. You don't want to just get thrown into the fray with all this volatility. So be very careful. Volatility is deceptive. So let's look at this drawdown curve, and you can see an even lower, smaller drawdown biased back to 2016. So if you go back here, if you go down here, this has worked well. 2018 is the most relevant in my opinion. Mid 2016 is good. This even works back in 2015. It works well going back to really 2013, 2014. But from the drawdown perspective, the drawdown goes down to about 40,000, or let's see, it goes down to right here, right at 40,000 to mid 2016. So if you look at it, you can drop this by $10,000. You can drop your max drawdown about $10,000 if you go back to mid 2016. You can also just say, look, the last 10 years it's $50,000. Anticipate larger drawdowns getting in at this point. This data goes back to February the 2nd. It doesn't include today's data right now. We're intraday on February the 3rd. And so you can see what this looks like, the cyclical nature of this drawdown curve. And a lot of these strategies we've had for a while, the length of the drawdown is lengthy right here. So it's one of the things I don't like is lengthy drawdowns. You were down here, and then the trend on your equity curve was up. So you started making money going in this direction, but the time to get back was significant. 10/18, 2013 to, it's about a year and a half drawdown. So I like fast cycles, and that's where you see a lot of density in the lines right here, or fast returns to equity peaks, and that's what we want. So we don't mind fast drawdowns to this level, to this normal levels, to get back to normal. So we're syncing up with the market right now, using strategies that we've had for a while with a few new ones, a couple of adjustments, and that's where we are. Let's look at the data now back to mid 2016. So you can see even more relevance in the 40K drawdown back to mid 2016. So I'm going to scroll down here, and I'm going to delete the data prior to prior to July of 2016. So scrolling back here as we go back, and coming up here, then deleting it. So then we can come back in here in the portfolio calculator, and you can see the cyclical nature back to mid 2016, what we're doing. Good time to enter this. It's about the same risk as the Micro NQ. The Micro NQ is right at about 1,000 before coming in today, and the Micro NQ is up just a little bit around break even. So it's about the same risk on the Micro NQ. For the 200K, I've already transitioned into this today with the I traded the Nasdaq strategy, Cobra 3 Nasdaq with the $600 stop loss without the range filter, but tomorrow I'm flipping that on to the range filter. So this is what this looks like. And if you have have a subscription, a current subscription, you'll be getting some updates, so you can trade this in accordance with your subscription based on the contracts and micros versus E-minis. But if you're trading two contracts on this, your worst case drawdown is going to be, historically back to mid 2016, is about 8,000. If you go back to 2012, your worst case drawdown will be 10,000, because we saw 50,000. So if you trade two micros, that's about 20% of that. So if you risk 10,000 to potentially make these kind of 20% of these returns. So two micros would be 100,000. Two micros here would be 88,000. Two micros here would be 6,000 on the year so far. We want to trade what's working now, and what's worked in the past. And so this was up in January. It's down the first 2 days in February. 2 days doesn't make a cycle. And it's worked well the last 4 years. So this setup's worked well the last 4 years, and it worked well in January. So we're syncing up, and past performance is not indicative of future results. So just working on this. We may have some increased stop loss in some of these other setups that you see here. Some of these strategies are getting stopped out right at turning points, and so we continue to adjust for that. It's normal to have stop running markets. It's normal to get stopped out at turning points, but you don't want it to happen all the time. So we don't want to increase our risk too much, but we want to make sure that we have a balance of winners. So that is the new stock index portfolio. Once again, I'll be sending that out. Hey, David Bean here. Welcome to Capstone Trading Systems YouTube page. Be sure to subscribe to join our community of algorithmic traders. We are real money traders. We share our winning streaks, we share our losing streaks, as well as market updates, strategies, and coding tips.